Hi, it's Dwyer. Money1776.com, a free site. Also, housing777.com, a free site. Today is September 18th, 2025. We heard earlier today that the S&P 500 has hit its all-time high. So, I felt a need to make this video today. Nothing I say in this video should be construed as financial advice. Trust no one, including me. If I mention a stock, your operating assumption should be that I might be interested in the stock or I might own the stock. Remember, the opinion you should follow should be your own. Just consider this video to be a second opinion from a complete stranger online. Now let me point out, when I was younger, I thought there were financial elites who had figured everything out, right? So I thought there was a clear-cut right way to do things, and that, what I was being told, what I was hearing, what was in the financial press was the truth. Right? What I want people to realize is that you need to be a skeptic at all times. Long-time investing decisions change, right? We find out that a pets.com, a petstore.com, they weren't viable. Understand, Blair Academy's John Bogle, giant in finance, came up with the concept of passive investing, investing in the entire S&P 500 index, right? This way you didn't have to be right because you owned all of the stocks. And as we knew at the time, the stock market long-term goes up, right? We'll neglect the fact that there have been stretches of American history when that hasn't been the truth. Go back and look at the 30s and 40s. Go back and look at the time period from 1968 to 1982. Right? But understand, the idea was, if you have the entire S&P 500, you were good. Right? Then, of course, offshoots of that took place. Right? If you had the NASDAQ, you were good. Right? Now, of course, we're in a world where we understand that's not the case. Right? The S&P index can collapse. Your question this morning, as we hear that the S&P is at an all-time high, should be to ask whether it's justified. Understand, the index is really supposed to reflect future profitability. Right? You need profits to justify value. Your business can't be built on hype. It actually has to be built on future profitability. Now, the argument I'm going to make here is that the current S&P 500 index price is unjustified. Right? You don't need a PhD in finance to figure that out. Let me also point out too that one of the biggest myths out there is that you need a college degree to understand finance. Understand, a lot of people who are very successful in the space don't have college degrees. Right? Just understand. You want to strive for understanding, not pieces of paper. Right? Jeffrey Epstein, who's been in the news for a variety of reasons, some of them incredibly criminal. I'm not here to dispute that. But Jeffrey Epstein was actually teaching at the Dalton Academy in New York City. And he didn't have a college degree, but yet he was a math wizard who, of course, went on to be a multimillionaire. If not billionaire, we can debate it. Right? So let me Let me just point out a few metrics. I've mentioned them in the past. I want people to understand that these metrics are in part why very successful investors, such as Warren Buffett, have increased their cash reserves in recent years. Let's talk about the Buffett indicator, which is the U.S. total market cap to GDP, right? That's the ratio. Now, one couldn't imagine how the U.S. total market cap could exceed GDP. You would expect this number to be around 100%. Right? The stock market should be valued to reflect U.S. output. Right? If there's any deviation, something's wrong. If you're at a number far above 100%, then the market's overvalued. Folks, this morning I checked the Buffett indicator. It's at 217.71% of the GDP. Folks, the market is more than twice overvalued. We're going to have reversion to the mean. We're going to have a market crash. Right? I don't need a PhD in economics to figure that out. Right? We've priced in profitability. That does not exist. The Shiller PE ratio. Right? Many people love Shiller, big time figure in the housing market. Yale professor, right? Academic. Just understand, historically, the median, which is the midway point, not the average, the midway point. The median of the Shiller PE ratio is 16.05. Again, 16.05. Since I mentioned average, let's talk about the mean here. The mean is 17.28. Right? Folks, today, the number is 39.67. In other words, it should be at X, it's above 2X, just like the Buffett indicator. Right, folks? This is not sustainable. As you see headlines and as you see people on Wall Street looking giddy, as you see different analysts touting different stocks today on CNBC and Bloomberg and Yahoo Finance, you need to just understand that the market in general is heavily overpriced. Let's talk about the recent Fed rate cut. Now, let me point out that we went through a prolonged period of time in American history, and you need to study American history, right? Figure out what worked, figure out what did not work. You'll figure out, too, what's needed. You'll figure out what's not needed, right? Just understand, we went through decades in American history where we did not have a central bank, right? I understand that, Hamilton was all the rage. He's supposed to have been some raging academic. Just understand that Andrew Jackson eliminated the central bank in the United States, right? One wonders how the economy can work, right? Suppliers and customers somehow are able to negotiate a price. And one wonders why we, in this era of information, right? Anyone can go online and, access foreign markets. We're in an era where China which used to be off the grid, now has companies that are publicly traded. You might own some Alibaba, you might own some Baidu, you might own some Neo. They're even in the coffee market. They're challenging Starbucks, Luckin Coffee, right? That's the era we live in now. Information is readily available. One wonders what the need is for a Federal Reserve, given that we didn't have a Federal Reserve for a meaningful part of our history. Well, you're going to get public narratives. And again, you need to be skeptical at all times. Folks, if money's involved, you need to be a skeptic. Right? Just like, back in the day, they had certificates of deposit that paid 5%. Right? You need to be a skeptic today, wondering why the 30-year currently pays less than 5%. Right? What the risk reward is when there's a sizable group that believes that the dollar is going to continue to be debased. Not be debased, it continue to be debased. So let me just say, Fed rate cut. Housing has been dropping. Right? We're supposed to believe that that's a bad thing. I agree. Incumbents are getting hurt. If you're a homeowner, you might be getting hurt, particularly if your home is in places like, the Tampa area in Florida, the Orlando area in Florida. Right? Sure, you might be getting hurt. The bigger question is, are more affordable homes a good or bad thing? Does increased affordability help or hurt young homeowners who are trying to buy their first home? Well, the Fed cut rates. We're supposed to believe that that's supposed to help employment. That's supposed to help the housing market. Right? Mortgage rates should drop a bit. People should be able to afford homes. Folks, that argument is flawed. It ignores the creditor side of the equation. Right? Understand, if the current yield curve on treasuries has the 30-year below 5% in this environment where it looks to me like we all know Social Security is going to be insolvent. Right, folks? We know that. It looks to me like we all know there's a pension crisis in America. A pension crisis that hasn't been resolved. It seems to me we all know, because more people are working at home, because we have greater connectivity, that commercial real estate in several cities, I'm in the Bay Area, San Francisco, for example, is a bubble. That there are unreported losses. That when we have to mark values to present value, we're going to find out that a lot of these buildings have more debt than they have equity. Right? If I'm a startup, why do I want to work in downtown San Francisco? Why do I want to pay office rents in downtown San Francisco when we can set up shop in Fremont and, because of the internet, have access to the world? Allow people to work from home. Right? You understand that a lot of the infrastructure that's based on prior generations, right? I ride mass transit, right? I sold each of my cars. I have sympathy for mass transit. I took mass transit. I took the train to go from Queens to the Bronx to go to high school when I was younger, right? I'm sympathetic to mass transit. Folks, the infrastructure right now might not be sustainable, right? A lot of people are no longer on mass transit because they can travel virtually. right? Understand, the world is changing fast. Why would I want to deal with LA traffic if I can work from home? If I can work from home, if more importantly, the consumer does not expect me to be in Century City or does not expect me to have a downtown Los Angeles office. Can I save on the overhead? Doesn't that reduce the risks? Right? Doesn't that reduce the need for the heavy bank loan? Isn't that the future? So let me just say, housing from this seat, right? Um, the rate cut's not going to save housing. The dot plot, future rate cuts, it's not going to save housing because you have a whole group out there who are thinking to themselves, am I getting enough of a premium to want to lend you money? If I'm a bank and they reduce the, interest rate, I have to think to myself, will housing 10 years from now in our area be worth 10 times the median salary? The answer might be no. Right? If the need to live downtown has dissipated, then even if we cut the carrying costs, even if we cut the mortgage rate, is it worth me lending you money? Right? If I'm in business to make a profit, why would I want to lend money if the collateral might not support the debt in the future? Let me say this too. Silicon Valley, for example. A lot of people are being laid off. Right? These Mag 7 companies are doing well. Google just became a $3 trillion company. Right? Very few are. Apple's already there. Right? Nvidia is there. Just understand, Google went through rounds, plural, of laying people off. Right? Investors loved it. The company, as I mentioned, has a market cap now of over $3 trillion. Right? Investors loved it because labor costs are expensive. And if I can disintermediate coders, right? People who, by the way, have spent a lot of their lives getting degrees in things like college science, who are finding out now that because of artificial intelligence, their careers have gone the way of the horse and buggy. Right? They're no longer in demand. Now, if I'm a lender in a place like Northern California, and I see people with great degrees, right? I understand a lot of workers want to come work for Mag 7 companies that are in the area. But I know that the labor demand is drying up. Right? If I understand the trend, then you can cut the interest rate, but if I feel the softness in the labor market isn't related to interest rates, it's related to need. And if I understand that the Mag 7 no longer has the same demand for, today it's coders, tomorrow it'll be lawyers, right? It'll be white collar workers. Just like finance is moving into the DeFi world. Just like Hyperliquid now carries its own ledger. You understand that some jobs are getting disintermediated. Right? You could cut interest rates. It wouldn't help the horse and buggy. 120 years ago, when the car started to be mass manufactured. So folks, I agree with Peter Schiff. The rate cut was because our government, the United States government, is operating at a deficit. Right? The total debt exceeds $37 trillion. Right? $37 trillion. Put that in perspective. That's more than Google's market cap times 10. And I'm mentioning one of the biggest companies in the United States. If I liquidated Google, I'd be able to pay 1/10 of the U.S. debt. When you're a debtor nation, like a real estate developer, you want low interest rates because you have debt you need to service. Right? We all understand that. So they can tag other narratives onto it. They can say, hey, this cut will help the housing market. Folks, it might not. Right? Understand, I'm a lender. I'm in the make money business. Right? I'm looking at the 30-year. It's under 5%. What's in it for me? Right? The first 10 years of your mortgage, the borrower is going to be paying primarily interest. That's really where the banks make their big money. How do I know you're going to have your job 10 years from now? How many jobs have been eliminated from the economy? Right, folks? Hasn't the world changed? Think about 10 years ago. Think about your cable box for your TV. Or think about your DVR. Think about how irrelevant that is. There was a time when Netflix would send you DVDs. That was the business model. It wasn't, hey, let me check out Netflix, point, click, watch. No, back then I was expected to put this disc in my DVD player, then afterwards return it to Netflix. Right, folks? That was recent. The world's moving that fast. In a world moving as fast as this world is moving. If I'm a lender, I've got to think to myself, wow, are these interest rates enough? After watching this video, take a hard look at the 30-year. Ask yourself, since your payment back is denominated in dollars, right? In dollars. Since the dollar is losing value, just look at the increase in the price of gold over the last 5 years. Since your dollar is losing value, would you make a loan even to a friend that pays you less than 5% over 30 years? Folks, there's a creditor side of the housing market. Right? The politicians can smile. Powell, can say, oh, due to softness and, can lower his voice and mention unemployment and other reasons why he's cutting rates. Folks, the rate cut is not going to save the housing market. Let's also talk about another part of the market that people need to think about. We'll call this opportunity costs. Now, if you're into, you name it, crypto, AI, you might privately believe that certain cryptos are about to explode. Right, folks? The runway has been cleared for takeoff. You understand a lot of these stable coins are based on Ethereum. You understand that the crypto people who used to be viewed as, crazies, right? Wow, they really think that people are going to buy into crypto. Now, of course, our government is talking about a Bitcoin reserve. Right now, we look at people like Max Kaiser, Michael Saylor, and we think, you know what? They might have been onto something. Right, folks? If you have made the money Bitcoin holders have made over the last 3 years. I don't have to go back that far. Right? Why would you want to buy a house? Let's say it's a $500,000 house. Let's say your down payment's $100,000. Grant Cardone has made this argument online. You need to know his name, Grant Cardone. Right? Why would I want to park $100,000 in a house that I'm paying a mortgage on just to secure the loan? Right? If I had that money in Bitcoin, just over the last 3 years, I'd make buku bucks. If I had that money in Ethereum, folks, Ethereum, as I make this video, is above $4,500 a coin. Right, folks? The run's just starting. Right? If I had that money in Ethereum, just understand how it works. I'd be making money on that $100,000. I might even be making more than the rental price I would pay to rent in the same neighborhood. Right? Folks need to do an analysis that asks hard questions like, what is the cost of owning a home? And understand, homes in many parts of the country now are, 10x or more of median income. Right? What's the cost of owning a home in this neighborhood? What's the cost of renting in this neighborhood? Right, folks? Because things are going to skyrocket. Not the market in general. I'm talking about just specific investments. Not all cryptos. Some cryptos. Not all artificial intelligence stocks. Just some artificial intelligence stocks. Right? Larry Ellison, the head of Oracle, for a brief moment was the richest man in the world. Right? Now, Oracle has gone on bull runs, but understand, in this market, based on what's happening with data centers and artificial intelligence, right, you have some players who've been very successful in the past, making more money than they ever had. Right? So ask yourself, if you're Larry Ellison, are you pouring money into San Francisco real estate? Or are you thinking about the opportunity costs, looking at things like, let's include the precious metals, gold, right? If you believe the US dollar is going to be debased further, why wouldn't you want to be in gold? Why would you want to lock in money for 30 years where your payout's going to be in US dollars, getting less than 5%? When you could be in gold, folks, gold, with all due respect to John Bogle, has outperformed the S&P 500 in recent years. Right? So if there's an investor readjustment, and I think it's happening, if you have young kids thinking, hey, you know what? I have enough money to buy a house. Why would I want to? Right? What are the homes in my area worth? 10x median income? I'm supposed to put down a down payment for 20% of the loan? And what exactly am I going to get for that? When I see my friends, when I myself have thrown money at some of these cryptos, and I'm making money hand over fist. When I myself might look at real world assets, real world tokenization, I might think to myself, a well-positioned Oracle crypto, one that provides real-time market information, which is going to be essential in the DeFi world. Something like Chainlink. My friends don't know about it. Maybe it's going to skyrocket. Would I be better off in 5 years with $100,000 in some real estate in an area in which I can rent for a commensurate price, if not a cheaper price? and have my money in Chainlink over the next 5 years? Or would I be better off buying a home, building equity like my parents did, baby boomers, from a different generation with different demographics, a different population distribution, right? Maybe baby boom economics is not what I want to strive for. Maybe I want to strive for the current market reality, one that involves remote working, one that involves game-changing, paradigm-shifting new technology like crypto, right, folks? The Genius Act was passed this year. It wasn't long ago you were hearing that all cryptos were going to go to zero, that the people involved in the crypto market were nuts, that Bitcoin had no future. Right, folks? That's how fast things are shifting. Let me close with this. Folks, look at the yield curve for bonds. Right now, you understand. If I'm lending you money, if I'm the creditor, you damn sure better promise to pay me more for a longer term loan than a short term loan. Right? If I'm lending you money for 5 minutes, okay, you could pay me a pittance. But if I'm lending you money for 30 years, I should get a premium because I'm passing up all these other opportunities. Right? I'm passing up investing in promising cryptos, investing in promising technologies like, artificial intelligence, right? Data centers, modular nuclear reactors, right? Energy seems to be demanding a premium these days, right? So just understand the logic. The longer the loan, the more the creditor should be paid back in terms of interest rate. Now, the yield curve, if it's inverted, if people are paying more for short-term loans than they are for longer-term loans, something's wrong. The market's unhealthy. Let's look at the yield curve this morning. The 1 month. Creditors are getting paid 4.09%. The 1 year, they're getting paid less. They're getting paid 3.66%. The 2 year, folks, they're getting paid even less than that. They're getting paid 3.5%. The 10 year, they're getting paid 4.1%. Folks, how could the 1 month market pay the same rate of interest as the 10 year? Folks, this is an inverted curve. Don't be fooled by it. The market is acting irrationally. Right? Couple it with the Buffett indicator being above 2x, where it should be. Add in the Shiller PE ratio being better than 2x, where it should be. And that should help you put today's news that the S&P 500 has hit record highs. Right, folks? You need to look past this. You need to realize this market is unhealthy. Right? You need to look at young people, and you need to realize that many of them with college degrees haven't been able to afford a house. So they've been forced out of necessity to look for rates of return in other places. Some of them have invested in Bitcoin. Some of them have invested in other promising cryptos. They've seen their rate of return. That now has become their expectation. So now we're to believe that if housing drops a little bit, these people are going to give up having held Bitcoin when it was $80,000. Now it's what, $116,000? I'm supposed to believe that someone who is sitting on capital gains of $36,000, right? If they own one Bitcoin, I'm assuming if it's a young person, just do the math, make it proportional. If they own 1/10 of a Bitcoin, understand they've still made a very healthy rate of return on that investment. I'm going to believe that that person is now going to pivot toward the housing market. Folks, we're kidding ourselves, aren't we? Right? So, folks, be careful. Be skeptical. Right? Understand. Look at the Buffett indicator, named after one of the best investors ever. Look at the Shiller PE ratio. Right? Look at the yield curve to put the S&P 500's new all-time high in perspective. And finally, consider the opportunity costs. Right? If I'm holding on to some crypto that is well positioned in real-world tokenization, particularly if I've made some capital gains on that crypto already, folks, I'm not going to realize those capital gains. I'm going to hold on to that crypto. It's much more valuable with much more upside for the future than buying real estate right now. I assume that thought process is held by many. Right? Don't be suckered into believing in all-time highs and, the market thriving in the future. How high does the Buffett indicator have to go before people reach the conclusion that this market is overvalued? Folks, right now it's at 217%. Those are my thoughts. Let me hear yours in the comments section of this YouTube video. Thanks for stopping by.